Now, those are the common things. Now, if you have a rental home and it was put on your tax return as a rental, it has been on your tax return as a rental, that can be different in that there can actually be very positive tax attributes to that. You may, a lot of times when we do those for our clients, they think this can't be possible. I got to write off a loss on my property, but I didn't have to pay debt forgiveness on the income, on the debt forgiveness. So you get a huge loss, but you don't have any debt forgiveness income due to insolvency. And the key is how they calculate that insolvency. And that's what a CPA will help you do, is look at, at the time you had the home and they short sold it or you walked away, what was your financial position at that point in time. So when you own rentals, that's the solvency, insolvency, and your financial position still is the same as when you own a primary residence, but you have the ability to possibly write off the loss on the home and sometimes not tax on the debt forgiveness income, which can have, you're getting all the good and none of the bad, which can be helpful, especially to people that are in, rough financial situations. That can help your taxes. Like I said, I always say this, you always want to discuss that with somebody that is very familiar with insolvency and debt forgiveness income. If you own, one other thing that's not as common but can be is if you own what I call pure investment. Pure investment means you've never rented out the property, never put it on your tax return as a rental. Those are a little bit harder, where you may not be taxed on the debt forgiveness if you're insolvent, but you don't get to write off as much of the loss right away. Those are what you call, just like if you sold a stock or something like that, where you might have heard a $3,000 loss per year. Rental property that has been on your return has definitely positive attributes to you if that's the way it was placed on the return. And like I said, if you don't know if that's the case, you should discuss that with your CPA to find out, hey, this was a rental and I had to, short sell it, or we had to modify it or something like that. They can kind of give you a pretty good idea. So insolvency really helps a lot of people that maybe don't think they're insolvent at the time, but they actually might be. That's a very important thing. And chances are, if you're financially destitute, in addition to having all the negative equity in your property, such as you owe a lot more than what it's worth, pretty good chances are that you probably won't be taxed on that. And we see that most of the time. That's not always a general, a fact. It's just kind of what we happen to see in our line of work. Not too many people will be paying tax on their debt forgiveness income given their financial situation. I can say, it's not common, but if you're a millionaire and you walk away from a piece of property and you have $1 million in the bank, yes, you would be probably, pretty good chances are you would be paying that on debt forgiveness income. But that's not common to most people. And we want to make that, I want to make my presentation to what applies to most people. So, like I said, primary residences, things that you will look at to determine that would be, was the debt used to buy the home or improve the home? So you're looking at how the debt was used originally when you got it or refinanced it. And you also have to remember that the law of the Debt Forgiveness, Mortgage Forgiveness Relief Act, it was very beneficial for, these situations happening in homeowners. So in respect, it was much easier and more favorable to choose that. So, like I said, you would choose something different if it was an investment, which means you just held it like a vacant piece of land, or something that you would put on your tax return as a rental. Different scenarios would apply to those instances of debt forgiveness income. So I think that's about all I have to say. Like I said, if you had any questions, you can always email me at scott@tampataxcpa.com, and I can answer any questions you might have. Or you can ask the CPA in your area. It's always just good to go to somebody that sees this on a regular basis. I think that's important. They can have detrimental tax things to you if you're not aware of them. So I appreciate it.
All right, Scott, I appreciate it. I know this, guys, it's not the most, it's a very complicated matter. It's very individualistic on the tax approach. So I've gotten a few emails sent to me and some questions right now, but I'm going to try to open up the forum to any questions we might have at this time. But I want to do a bit of a brief recap along with this. What Scott was mentioning is about, again, the Mortgage Debt Relief Act, which has to do, again, with on your primary residence. If you're, again, if you short sold your property or you got foreclosed upon, unfortunately, you would have a 1099-C, which the government, the IRS, would treat that as income. Is that not correct?
Yeah, it has to be reported on your tax return, but it may not be taxable. That's the key. Is, you report it on your return. It may not be taxable, but you still need to report it if you receive one, and the bank should let you know that.
Okay. And with that, sometimes there is Scott, maybe you can attest that, there's a little bit of a delay. So if you short sold your home, and using the same example, your balance was $200,000, you sold it for $100,000, and this was your primary residence, you have a deficiency difference of $100,000. Now, that 1099 may be issued not necessarily that calendar year, but it may be issued one, maybe even two, but maybe even most probably the next calendar year, depending on when the lending institution wrote your balance off as a loss and became a deficiency balance. And then it has to go through the REO process. But just kind of want to make that a little bit clear. And with the back to the primary residences, the mortgage, and you said the Mortgage Forgiveness Debt Relief Act of 2007 is where primary residence people, individuals, can get their 1099 waived because the IRS treats that as income. Correct?
It's normally treated as income, especially, always, like I said, one of the key things you always look at is what type of debt was it? Was it used to buy your home or improve your home? If part of that debt was used, like I said, for other alternative things not related to your home or improving your home, it could be taxable, but a lot of times it's not. So like I said, it has to do with that piece, whether or not you're insolvent. So the Home Mortgage Relief Act is more favorable, especially that applies to the most common person that just bought their home, owes more on it than it was worth, and it's the original mortgage they took out. That 9 times out of 10 will not be taxable.
Okay.
If that's what applies to you.
Now the issue is that, just to reiterate, some of the major, that's to cover the primary residence, but
right.
The other aspect was the investment properties.
Right.
And from what you were mentioning, and correct me obviously if I'm wrong here, there are 3 basically major areas to try to combat your 1099-C and or A, your 1099 deficiency, your income on investment properties. One being the primary residence exception for investment properties, and from what I understand that to be, if you had your rental home as your primary residence 2 out of the last 5 years, there's an exception to where that will allow it to be considered your primary residence, and you could use that as try to combat the tax write-off.
Right.
And I'll let you answer that. So you're shaking your head. There are a few things you want to add to that. Also, the insolvency side of that, and that basically is when you do the settlement with your lender. It happens pretty much the day you settle with them. They take a snapshot of all of your assets and liabilities, and you go through the calculations to see if you're insolvent,
right,
more or less. And last but not least is the capital loss ratio, and there's capital gain / loss, to where, could you explain a little bit more detail how that works? You're basically what you bought the home for back in however ago, minus your expenses, your closing costs that were involved in it, minus any expenditures you put into that property. You fixed a new water heater, you put a new AC, you repaired a new AC unit on it over the years. That total number minus what you sold it for, and that includes the selling cost, the sale cost of the transaction, which is typically around 15%, and you minus that too, and you get a net number. And most times, what you're seeing from your clients is where it turns out to be a negative, it turns out to be a loss a lot of times. So, I was wondering if you could kind of elaborate on that a little bit.
Yeah. Like I said, when somebody says investment property, if you're doing tax work, investment property is a very general term. Investment property can mean 2 things for your tax returns. That is very black and white. Investment property can be a rental, which means it's been put on your tax return. Like I said, you want to talk to somebody that does your taxes, or you know for a fact that I've been renting it out and claiming income on it. That is a rental. That has much more favorable tax treatment. If you lose money on the sale of that home, whenever you short sell it or walk away, you write off the loss, the entire loss, when you sell that. An investment, a pure investment property, is a property that you just hold and you've never ever rented it out or received income against it. That is not an investment home is not a second home. Second home is different. Second homes, you don't get to take the losses on if you sell one. They're the same as primary residence. If you sell them at losses, you get no advantage to write that loss off. But you may not be, you probably won't be paying tax on the debt forgiveness income. So that's something to keep in mind is how was it used? You know, if it was a rental property and it's put on your return as a rental and you're losing money on the sale, you can take that entire loss sometimes that year and not have to pay money on the debt forgiveness portion, which is very favorable. So you're getting all the good for tax purposes and leaving out the bad. We see that sometimes. So there's, you know, it has to do with how it's used, and most of the time it's either primary residence, a second home, or a rental where it's been on the tax return. Those are the most common things.